All right, guys, so I'm going to walk through activity 4 with you guys, the activity from chapter 4. These are difficult, so I want to make sure that you guys understand them. Typically, I don't just give the answers out for these. I'm not going to provide a key or anything like that, but what I will do is walk through this activity so that you guys can kind of check back on your work and use it as a way to study. So again, we did part of this in class. If you were in the seated section, in the online section, you haven't seen this yet, but that's okay. We're going to work through it right now. So essentially what we're going to do is we're going to take a look at these 6 different transactions. And for each of them, we're going to record what accounts they use, what the adjustment should have been, and as well as the ending balance. There is one really important piece of information, right? It's the fact that we have to assume that we didn't make any adjustments the rest of the year. Okay, so remember what we're doing here is not those original journal entries. Okay, what we're doing is we're going to be looking at the adjustment that needs to happen after those original journal entries were made. So for instance here, let's say October 1st, 2024, Hurricane lent $9,000 to another company. The company signed a note indicating principal and 12% interest will be paid to Hurricane on September 30th, 2025. So here's where we're going to use that ARC formula, right? The amount times the rate times the time. This is what's going to help us do this. Now, we have to pay attention to a couple of different things. The first thing you want to look at is your date. When did we get this? Well, we got it on October 1st. So that means if we are making adjustments on December 31st, we've had it for 3 months, October, November, and December. So that's going to be our time. Our time becomes 3 over 12, right? What is our rate? Well, our rate's 12%. And how much did we borrow? What was the principal amount? $9,000. Okay, so this is where we come up with those percentages here, or come up with the amount that we're going to adjust here. So here it's going to be 9,000 times 0.12 times 3 divided by 12 is $270. Okay, so what was our balance before the adjustment? Well, it was $0. We didn't have any money in those accounts. So on both statements, the balance sheet and the income statement, it was 0. The adjustment we need to make on December 31st is $270, right? And this will be to interest payable. And then the adjustment on the income statement will be $270 to interest expense. Sorry about that. Okay, so our ending balance at the end of December 31st is going to be $270 for both of those accounts. Okay, so if we want to look at the T accounts for these, draw out your T tables here, right? And see what exactly that looks like. And we can do that here really quickly. Let's just go with our interest payable. Okay, so it started at 0. And we added 270 to it. We remember that our balances are just the increases and decreases to an account, so we have 270. And same thing with interest expense, right? We started with 0. We added 270 to it, so our ending balance at the end of December is $270, right? These are our T accounts. Easy ways to follow through. Okay, so moving on to the second one. On November 1st, 2024, they paid its landlord $4,500, representing rent for the months of November through January. Okay, the payment was recorded in prepaid rent for the entire amount on November 1st. Costs related to rent in the first 10 months of the year total $15,000. So here we can just say 15,000 divided by 10. So we are paying $1,500 per month in rent. Okay, so what are our adjustments here? What are the accounts that we need to be paying attention to here? Okay, so our balance sheet that we want to pay attention to is going to be our prepaid rent, right? That's going to be our asset. Okay. Our income statement account is going to be rent expense. That's the expense account. The balance before the adjustment was $4,500, right? It tells us that right there. Okay. And our expense was $15,000. That's the 1,500 times 10. What's our adjustment at the end of December? Negative $3,000, right? Okay, we've got rent for 2 months, November and December, that's $3,000. We're going to increase our expense by $3,000 here. What are our ending balances? Well, we've got $1,500 here, and then we've got $18,000 in rent expense. Okay, so hopefully you are following through on that. It's not terribly difficult. There are a couple ways to get to that $1,500, right? You take 4,500 divided by 3, that's going to give you $1,500 per month. Or you could take the $15,000 that they paid for the other 10 months divided by 10, and that gives you the $1,500 per month as well. Okay, so a couple of different ways to get through to that. All right, so let's take a look at number 3 here. So on August 1st, 2024, they collected $13,200 in advance from another company to provide consulting services for 1 year. So there are a couple things going on here. The first one is they collected, meaning they got cash, right? Collected, comma, cash in advance. So they haven't performed any services. They haven't met their duty. They haven't met the performance obligation yet. So this is going to be that liability account, that deferred revenue, right? And then it says for 1 year. What this tells us is that this is a contract, and so when you have a contract, you will recognize revenue evenly throughout the entire life of that contract. So this is going to be that $13,200 divided by 12. Okay, gives us $1,100 per month that we are going to collect in revenue. Okay. So we've got the math part of it figured out. Let's talk about what our balance sheet account is here. And our balance sheet is going to be deferred revenue. Okay, that's our balance sheet account. And then our income statement account is going to be service revenue. Now remember, this is not the original entry. This is the adjusting entry for this. So this is assuming that how much have we collected as of December 31st, 2024? How much of it is actually revenue now? How much of it did we earn? So what's the answer to that? Well, we have August, September, October, November, December. That's 5 months. So you can take that $1,100 per month, multiply it times 5, and that's going to give you $5,500, right, that we're going to have each month. Okay, so our December 31st adjustment is that we are going to reduce our deferred revenue liability by $5,500 because we've earned $5,500 of that. Remember, it started out at $13,200. Okay. What did our service revenue start out at, though? Well, that's interesting because down here it tells us they had generated $160,000 in other service revenue for the year. So other revenue that does not include this $13,200 is $160,000. We're going to increase that by $5,500. So what are our ending balances? Well, our ending balance for deferred revenue, we still have $7,700 left to earn, and we have $165,500 worth of revenue. Okay. So that is the first 3 transactions. We'll do the next 3 transactions in the next video.